Hello. Now today we are going to learn the theoretical concepts. Earlier session we have covered 2018 past paper theory. Now in this paper we are going to cover the 2018 other past paper theories. Also I have added some more to learn and clarify your gray areas which is relating to the financial statement analysis. Now let's move on. The first slide, I will recall your memory regarding the earning management. Earning management strategies used to boost the earning by the managers. There are few things they are doing. First one is increasing income. Sometimes managers are adjusting their accrual income and reported in the current period to boost the profit. Then second one is big bath. Sometimes when there are future losses, they are not trying to record it in the current period, but they are recognized more than it in the future period. This way they can boost the earning. The third step is income smoothing. Sometimes in the situations they are deferred the profit in order to make a boost profit in the future period. Right? Then next way, we are going to identify what are the additional information or the additional qualitative and quantitative characteristics of the financial statements and financial reports are needed by the managers. Right? The first one is, okay, these are the additional information are in the financial statements. Actually, these are provided to have a more understanding about the financial statements, about the company, to make decisions by the stakeholders. One is management report. In the management report, they are provided by the CEOs and chairman's view with regard to the company's prospect, their responsibilities, etc. In the audit report, they are providing the true and fair view of the financial statement by the external auditor, and explanatory notes, they will provide what are the additional information regarding items included and excluded in the financial statement and what are the policies, accounting standards they have used. And in the supplementary information, this is a schedule which is prepared by the publicly held securities such as exhibits to regulatory filings from the Security Exchange Commission, then other notes which is needed by the government. And in the social responsibility report or the CSR report, they are providing what are they have done for the society as a company or the uh, society maker. Then in the proxy statement, this is given to nominate the person behalf of a stakeholder, shareholder to a AGM. Then next we'll move on to the limitations of financial analysis. Normally, these limitations are common parcel of limitations of vertical analysis, horizontal analysis, limitations of ratio analysis, as well as these are part and parcel of the limitations of the financial information as well. First one is, we know that by doing the financial analysis, it's not give the answer for all the questions we are raising. So, financial analysis have a limitation. They are limited for a certain areas. And we know that different companies adopting different accounting policies and practices. Some are using FIFO, some are using LIFO. Some are using straight line, some are using reducing balance method. So when there are different accounting policies and practices, it's difficult to do analysis and compare the companies or a company in the same industry. Calculation of ratios, sometimes we know that different ways have there to calculate the ratios. So we are limited to provide a good answer for our stakeholders by analyzing the financials. Then we know that financial statements are historical. How we can predict from the history for the future? Therefore, there is a limited use in achieving and understanding performance in future. Then one we know is the window dressing. Window dressing is a way of manipulating financial statements or financial position in order to boost or report in favorable terms. And seasonality can be affected. In certain industries such as retail, clothing, textiles, sometimes these food cities, wholesale warehouses, wholesale and retail shops, their sales are dependent on the seasons. In certain areas, business performance will be boosted due to seasons, and sometimes due to seasons, our performance may not be reflected in true form. Such imagine in the past scenario as well as the corona crisis on the hospitality sector. Then, if there are certain variation, even though we are preparing the financial statement, we are unable to identify these crises or these seasonalities in the statement of income statement and statement of cash flow. However, this may have only impact in the statement of financial position. Then the business analysis. You have done this in your assignment? Business analysis is the evaluation of company's prospect and risk of business decisions. Right? Financial statements most of the time provide quantitative factors. But analyzing the business, we are able to predict and identify who are our customers, who are our suppliers, what are the threats we are facing, then what is the industry opinion, etc. Then what are the advantages of common size analysis? Most of the time we know that it can be used for intercompany comparisons. The vertical analysis and horizontal analysis we can use to compare the intercompanies in the same industry or different industries. This is an effective way of understanding key trends over time. We be able to understand the key trends over time. Right? Then it's better for the intercompany comparisons as well. Then sometimes it is helpful in analyzing structural composition. Who are the companies which are invested more in the current assets and more in the non-current assets? Then by analyzing the structure, we can predict what are the items they have invested more, what are the items they have invested less, what are the expenses the company income more. So they can understand the structural composition and how it's changed over the time by doing the historical horizontal analysis as well. Then most of the effective way to compare the company's financial statement to industry averages. Industry averages can be only compared in the common size analysis because it's normalized the big or small company based on their average. Therefore, it's enable them to compare with the industry average easily. Sometimes it helps to reveal the missing drivers. When we are doing the common size vertical analysis one by one, if item missing, we can clearly identify this one. But this won't be happen in the ratio analysis because we are taking the summary and we are doing the analysis. Then what are the disadvantages of common size analysis? We know that common size vertical and horizontal analysis are basically more beneficial for the companies. However, this does not help to take decisions since there is no standard percentage regarding the various companies, assets, liabilities, how much we should campaign, how much we should help. There's no standard. Sometimes this does not recognize the changing price. If there's an inflationary effect, since they are normalizing the figures, they won't reflect the true nature of the price level change. And if there is a consistency between accounting principle concepts, then what will happen for the companies? Then free cash flow. We have known this one in previous time as well. Free cash flow is a method to measure company's financial performance, and here we are measuring it how much the excess of the operating cash for the company to paying its capital expenditure and dividend. This is the method used to calculate the free cash flow as a equation. Then free cash flow, we can see it is the earning before interest tax. Then we are charging the tax, and we are going to add the depreciation, amortization, which means non-cash items, and we are going to deduct the change in working capital and capital expenditure. You should remember this free cash flow and what is the importance, because in each paper we can see they are giving importance for this concept. Then operating cash per share and earning per share, and what is the importance, and we have to identify if this is vary, what is the impact on the financial statement. This operating cash flow per share is a ratio that measures the proportion of the profit that is converted to a cash. If the ratio is better, then it's reflect a better efficiency in cash management. Right? If this is greater than 1, earnings are high quality because the company is generating more cash than reported on the income statement. However, if this less means company have a positive earning in the income statement, however, the cash flow might be negative. We know that depreciation is a non-cash expense. It should be added back to the profit to calculate the operating cash. Right? In this situation, operating cash will be higher than the profit. Therefore, operating cash per share will be greater than the earnings. Now, next one is the purpose of the financial statement and how the statement of cash flow help to overcome the shortcomings of the other two statements. Other two statements mean what? Balance sheet and statement of cash flow. Right? Now, the first one, the income statement. We know that income statement prepared to identify the performance over a period of time. Right? Now, it's represent the revenue, expenses and earning for a given period of time in order to measure the performance. Balance sheet, whereas it shows position at a certain point of time, which means it can be a month end or it can be year end, it can be a quarterly end. It shows the asset, liabilities and equity of the company. Now, in the case of statement of cash flow, it represents the inflows and outflows, some mainly according to three categories: operating, investing and financing. Then, both income statement or balance sheet not provide the detailed information of the cash. However, the cash flow statement is enabled to show the details into three categories as well. Then the difference between the depreciation and amortization. We know that in the long-lived asset session, the depreciation used to depreciate the asset of tangible asset, whereas amortization is used for intangible assets except goodwill. For goodwill, we are using what? Impairment. Then, in the past paper, it said that usefulness of financial statement or financial position is limited and it is only a snapshot. Why is it? We know that financial statement or financial position is prepared for a certain point of time. Therefore, it only contains asset, liabilities and equity at a particular point of time as at 31st December or 31st March, etc. This means it only provides a snapshot at a point and it a limit for practical use. Now next one is revaluation. In the long-lived assets, I have identified the upward revaluation and downward revaluation and its impact on the ratios. Now here it asks the impact on the ROCE. ROCE is what? ROCE is the profit before interest tax divided by the capital employed. Right? This is used to assess the operational efficiency of the company and how well the capital employed by an entity is used to generate profit. We know that upward revaluation will boost the non-current asset value, right? And reserves of the company as well due to revaluation reserve, which means the capital employed will be increased. Thus, it will adversely affect to the upward revaluation and ROCE. Then what are the factors causing increase in GP margin? Gross profit margin is gross profit divided by sales. When there is increase in selling price, the sales will increase. As a result, GP margin increase. When there is a decrease in cost of sales, then also GP margin increase. Sometimes the change in product mix can have a favorable impact on the product margins, and also it may have a reason to increase the GP margin as well. Then these are the two methods of cost accounting, FIFO and LIFO, and based on the inflation, the result of the financial statement will differ. When there is an increase in inflation, we know in the FIFO, we are first selling the first and we are keeping the latter in the stock. When there is increasing, since the costs are increasing, what? The cost of goodwill lesser under FIFO method. However, as result, there will be an increase in the profit. In the case of LIFO, what will happen? We are keeping the earlier purchase stock in the stock and we are selling the current purchase. Therefore, when the costs are increasing, it will increase the cost of goods sold and it will decrease the net profit. Converse to this, in the deflation situation, under FIFO method, it will lower the profit and it will increase the cost of goods as well, cost of sales as well. But in the case of LIFO, opposite will happen. Then economic earning and accounting earning. Economic earning is the true earning which is related to the shareholders and is different from the account earning. It's considering the what? Sustainable cash flow that can be paid to the shareholders and it's considering the implicit cost as well. This can be calculated in two methods. Sometimes net operating profit after tax, then we are considering the WACC, weighted average cost of capital, and we are multiplying by the invested capital. Sometimes we are taking the difference between this and then we are going to multiply it by the invested capital as well. Then earning management, we know that accounting earning is based on the accrual method. This can be manipulated by window dressing, account smoothing, earning management strategies, so many methods. Therefore, we are considering that economic earning is better than the accounting earning because economic earning is based on the complete set of financial information which is available, and it will normalize for all the companies, and it will more accurate representation of the company true earning, and it will understand the cash flow nature of the business as well. Therefore, financial analysts prefer economic earning over accounting earning. Then the cross-sectional analysis. We know cross-sectional analysis is used to compare the interfirms in the same industry or can be different industry. This analysis is an effective way in order to identify the distress. Distress means the financial riskiness of the company. Portfolio analysis to identify what are the most suitable companies to merge or acquire. And sometimes it used to measure the credit worthiness of each company. And it will locate the structural difference of certain companies by analyzing the cross sections of the firm. And these are the advantages of this cross sectional analysis. Then the disadvantages of the cross sectional analysis is we are difficult to predict the future based on the past information. And also, since there are change in economic, social and political fiscal factors, we may need some more additional information. And on the other hand, the overall picture of the statement analysis cannot be only drawn, right, by identifying the industry averages. Sometimes it's difficult to find the industry average for cross-sectional analysis. Sometimes these industry norms may not be a good one. We know that 2:1 current asset norm and 1:1 quick ratio norm cannot be applied for each and every industry. Then the time series analysis, it's also a type of horizontal analysis, but it is based on the base year we are predicting the future. These are the advantages of the time series analysis. It provides the information for a financial position over a number of years, and we can prepare a graphical representation so we can identify what are the ups and downs of the firm, and we can predict the company in advance by analyzing the time series, and performance can be compared with the industry average as well. However, there are certain disadvantages of the time series analysis. This is in short term cannot be suitable, and it's helpful to evaluate the overall performance of the firm, and the ups and downs may not predict the cyclical patterns of the economy, and it may not able to find the mistakes in the grassroots mean the bottom level of the management. Okay. Um, Go to these factors result in declining in LIFO reserves as well. I have given these in the note, and factors in LIFO reserve is like for liquidation and decline in price.